If you earn over £90,000 a year in the UK, you are already in the top 5% of earners. So why do so many people at this level still feel financially stuck? Statistically speaking, you ought to be building real wealth. And yet, so often, that does not happen. A high income arrives, and with it comes a peculiar kind of pressure, more tax, more complexity, and sometimes a nagging sense that, despite the good salary, you are not actually getting ahead. Welcome to Wealth Architecture. My name is Mark. The biggest mistake I see people make is this. They reach for products before they have a plan. They ask questions like, which ISA should I open? Should I overpay the mortgage? Which pension fund is best? These are perfectly reasonable questions, but they are being asked in the wrong order. It is a bit like worrying about the color of the front door before the foundations of the house have even been built. So today, let us forget about products for a moment. Instead, let us talk about structure. Drawing on research from the Bank of England, the Financial Conduct Authority, HMRC, the Office for National Statistics, and the Credit Suisse Global Investment Returns Yearbook from London Business School, I want to walk you through the order your money should follow. No jargon, no fluff, just the steps. You might be thinking this all sounds sensible, but why now? Why does the order matter today? Three things are happening at once. First, fiscal drag. The Office for National Statistics recently confirmed that self-assessment tax receipts hit record levels, more than £30 billion in January 2026. That is roughly double the figure from the previous year. Frozen tax thresholds are quietly pulling more people into higher tax bands. You may be earning more, but you are keeping less. Second, inflation. As of March 2026, inflation has remained stubbornly above the Bank of England's 2% target. Researchers at London Business School, Dimson, Marsh and Staunton, have tracked global markets for more than a century. Their latest Credit Suisse Global Investment Returns Yearbook makes a simple but important point. When inflation lingers, the old assumptions shift. Cash earning 2 or 3% in the bank is not protecting your wealth. It is slowly eroding it. Third, the retirement landscape is changing. The Financial Conduct Authority's Retirement Outcomes Review found that increasing numbers of people are entering drawdown products without professional advice. At the same time, HMRC guidance is very clear. Once your income crosses certain thresholds, £100,000 or £200,000, the tax treatment of your income can change dramatically. The 60% tax trap, the tapered allowance. These are real and they catch people out. So step 1. This is the step almost everyone skips, and it is where even very clever people come unstuck. You look at your bank account each month. The salary lands. It is a good sum, but somehow you still do not feel ahead. Perhaps you started later than your peers. Perhaps you spent your 30s building a business, traveling, or focusing on your career. Now you are earning well, but there is a quiet pressure to catch up. That feeling is understandable, but it can also be dangerous, because it pushes people towards products before they have a structure. Vanguard conducted interesting research on investor behavior. They tested 2 types of risk warnings, the traditional regulatory wording and a clearer, more accessible explanation. The clearer version actually made investors more confident to proceed and far less likely to abandon the process. Why? Because when people understand the structure, they make calmer and better decisions. What many people do instead is skip the quiet work. They hear about a promising investment or a hot stock. They feel pressure to get their money working. So they open an app and buy something exciting. But they have no liquidity plan, no tax plan, no thought about how they will access the money later. That is not investing. That is gambling while standing on a trap door. Layer 1 is the foundation. And if this layer is weak, everything above it eventually collapses. There are 4 parts to this foundation. None of them are exciting, but all of them are non-negotiable. First, cash flow clarity. You need to know, to the pound, what comes in and what goes out every month. Not to punish yourself with a rigid budget, but to make decisions based on facts rather than guesswork. High earners often assume the problem is investment returns, but more often the issue is invisible leakage. Small inefficiencies repeated every month quietly reduce the amount available to invest. Clarity is what allows you to direct money deliberately rather than hoping it accumulates by accident. Second, the buffer. Financial Conduct Authority resilience data from 2024 show that many working-age adults have less than 1 month of essential expenses in savings. That is not resilience. Your goal should be 3 to 6 months of essential expenses in easy access savings. For many high earners in their 30s or 40s, that might be £20,000 to £30,000. It earns very little, but it prevents you ever having to sell investments at the worst possible moment. Third, employer pension matching. This is the closest thing to free money you will ever see. If your employer matches your pension contributions, take it, every time. It is effectively a guaranteed 100% return on day one, plus tax relief. No investment strategy in the world can promise that. Many people underestimate the impact of this. A 5% salary contribution matched by an employer instantly doubles the invested amount. Over a 30-year career, that difference compounds dramatically. Ignoring an employer match is effectively refusing part of your compensation. Fourth, eliminate high-interest debt. Paying off debt at 20% interest is equivalent to earning that return risk-free. Layer 2 is where many people want to begin: investments and growth. But we are still building the structure. First, income protection. Your income funds your entire financial life. The mortgage, the bills, the lifestyle you have built. If illness or injury stops you working for 6 months, what happens? A good income protection policy ensures the most valuable asset you have: your ability to earn. Next, we must talk about market volatility. Research from Dimson, Marsh and Staunton shows that global equities have delivered roughly 5% real returns above inflation over the long term. But the journey is not smooth. During the 1973 to 74 crisis, UK equities fell more than 70% in real terms. More recently, 2022 reminded us that both stocks and bonds can fall together during inflation shocks. Volatility is the price of admission. If you hold 100% equities, you will experience a 30 to 50% drawdown at some point. The question is not if, it is when. Research on loss aversion shows the pain of losing money is felt roughly twice as strongly as the pleasure of gaining it. An 80-20 portfolio will not reach the same highs in a bull market, but it cushions the falls and helps investors stay invested through the cycle. Layer 3 is where the game changes: tax efficiency. For higher rate taxpayers, this is where large amounts of money are often quietly lost to HMRC. Pension tax relief allows higher rate taxpayers to reclaim 40% relief on contributions. And for some income levels, the effective relief can be even higher because pension contributions restore lost personal allowances. This is not about products, it is about structure. The ISA is a powerful wrapper. No income tax, no capital gains tax, no further tax on dividends. But contributions come from income that has already been taxed. A pension, on the other hand, offers tax relief on the way in. For a 40% taxpayer, £10,000 into a pension may cost only £6,000 after tax relief. That is why wrapper order matters. Imagine 2 people, both 45 years old, both earning £120,000. Sarah puts her entire £20,000 of savings into a stocks and shares ISA. James looks at the tax structure first. He contributes £15,000 into his pension, restoring his personal allowance and reducing his tax bill. The remaining £11,000 goes into his ISA. James ends the year with more invested and a lower tax bill. Now, extend that difference over time. James continues receiving tax relief on contributions, while Sarah continues investing only from income that has already been taxed. Over 10 years, the gap between them widens dramatically, even though they are saving the same amount each year. That is the power of structure. None of this is about being clever. It is not about predicting markets or picking winning stocks. It is about structure. Getting the order right and building something that holds steady whether markets are rising, falling, or simply moving sideways. If this framework has been useful, the next video in this series looks at a very specific question. Because the decision between pensions and ISAs is not simply about tax. It is also about access, retirement timing, and how withdrawals are taxed later in life. Is it better to prioritize the ISA or the pension? The answer may surprise you. Thank you for watching. I will see you in the next one.